Today is the day the Lord has made, and these are the times through which God has decided we shall live. And Zach Abraham is with me to talk in a special episode about Silicon Valley Bank and all of the aftermath of this. Had a friend ask me yesterday, Zach, if this was a serious thing, and I said it seems isolated, it seems okay, but the behavior is very, very sloppy and scary and malfeasant. So as we record this on Sunday at 12:30, where do you see things now?
Well, full disclosure, I'm going to throw just more than opinions at you because one of the small companies I'm on the board of, we now, hey, risk management, right, Todd?
Right.
So even at those companies, we spread our deposit base out. Thank God we did, because Silicon Valley Bank has actually been a very good partner to us. I think it's important that they did a lot of good work with VCs. They gave us better terms than a lot of other places did. I hear them getting just kind of thrown under the bus right now, and I've got plenty of harsh things to say about them, and I'll get to that. But they were the job they did in banking with the companies they did it with. They did a real service, and they were helpful, which is why we had an account there. But we've got about, it looks like somewhere between, 80 to 150 grand in jeopardy right now that we might take a haircut on. So I've been dealing with this as a board member, and we've been in the middle of it. So first off, I will just say, you're going to hear a lot of, here it comes again, bank run. This is absolutely nothing like 0809. Okay. So, and let me clarify this by saying in 0809, it's something that we all talk about, and yet I hear very few people, even in the industry, really understand. The issue with 0809 was not bad mortgages, it was good ones. There was a rule on the books at that point that when you if you were a bank and you owned AAA rated securities, you did not even have to report them on the balance sheet. They were treated like cash. Okay, so a lot of these banks took advantage of that and went out and bought mortgage-backed securities paying 5 to 6%. Right, which cash wasn't paying, which means it is more risky than cash, which means that was a bad regulation, right? And the problem was when the mortgage business tipped over, no other bank knew what was good and what wasn't. So the mortgage-backed security market froze. So banks have to mark to market every single day their securities. Well, all of a sudden, this pile of stuff sitting over here on their balance sheet that was being treated like cash, you had to mark it down 40, 50, 60, 70, 100% in a day. So all of a sudden you went from having all this cash on your balance sheet to nothing and you were insolvent. Okay. That isn't what's happening here. What's happening with with Silicon Valley Bank is part and parcel to a lot of things that you and I have been talking about and a lot of things we've been talking about on our show for about 7 years, which is, guys, when interest rates start going up, it is going to blow holes in things that people aren't expecting because people have been lulled to sleep over 15 years of 0% interest rates. And when interest rates start going up, everybody's going to talk about the impact that's going to have on the economy. And they're going to fail to think about the impact it's going to have on bank and company balance sheets when their bond portfolios lose 20 to 30% of their value. Okay. These guys went out. Why they did this, people have asked me this question. This is a rookie mistake. When I look at this situation, I immediately would think that they hired a 23-year-old to manage their risk department. Okay, these guys bought a swath. They're a $200 billion deposit bank. They bought $88 billion worth of mortgages. Okay, paying somewhere, I've seen some reports as low as 1.7. I've seen some reports at 2.7. I'm going to go with 2.7 because it makes more sense. But they bought, just think about this. They bought $88 billion worth of mortgages with the 30-year rate 20 basis points below its historic low. Okay. They didn't hedge their duration risk, meaning when rates start going up, right? What are bonds? Well, a 30-year mortgage right now is 7%. Okay, so those mortgages they bought paying 2.7%, they're down 20 to 30% in value. Okay, now we all know how rates went up. These guys could have hedged that interest rate exposure when mortgages hit 3, when they hit 3.5, when they hit 4, when they hit 4.5, when they hit 5, when they hit 5.5, they didn't hedge. They didn't hedge. So they just let a massive hole get blown in their balance sheet. Why? I have no idea.
So let me share a theory with you, because I don't have the inside knowledge. I would say, I guess, in full disclosure, 2 of my startups, Zach, banked at Silicon Valley Bank.
Okay.
And we found them equally helpful. I would say this, that it would have been nice if someone at the bank cared enough about their depositors to say, we've got 98% or 97% of our deposits are not FDIC insured. Do you think maybe we should get with those people and offer them different instruments, since this is just sitting there naked? Let me offer you this theory. There's a woman named S. Rapa, I'm guessing. Okay, this is what she chooses to emphasize on the SVP UK Limited website. Okay, Silicon Valley Bank UK Limited. She emphasizes that she is a woman who likes to have sex with women, and she is on a board that promotes visibility of men who like to have sex with men, women who like to have sex with women, and people who believe they're born in the wrong body. And her title, Head of Financial Risk Management and Model Risk, Silicon Valley Bank, UK Limited.
Oh, so
I mean, in her defense, she's pretty busy.
Yeah. So I actually tweeted this out where I said, hey, now this is me just using the benefit of hindsight, but
right.
maybe having a risk visibility day should have been prioritized slightly higher than having lesbian visibility day. Right. So, but Todd, here's my thing. And this is why we focus on risk so much. Okay. Think about the fact that she was the head of their risk department. And that's what she's talking about, right? The 15 years of 0% interest rates and the Fed constantly sterilizing every bit of risk in the market. That's what this has created. This, you can afford to have somebody as your risk manager because there hasn't been any for 15 years, right? This is what scares me. Is you've had 15 years now, and think about that. We people that are north of 40, we're like, well, 15 years is a good spell, but it's not. Guys, that's 20% of the average human being's lifespan. Okay, where you have had risk anesthetized and sterilized and rates at 0. Okay, that puts people to sleep. What scares me about this is I will bet you dollars to cents they're not the only bank that has got this problem. Okay.
Well, yeah, but they wouldn't be, Zach, because ESG scores changed what risk meant.
Yes.
Your risk was you might be boycotted if you're not sufficiently leaning to the left, if you're not sufficiently insane. So yeah, of course, her sexual habits was mitigating risk. Mm-hmm. In an ESG scenario, her sexual habits mitigated the risk that was being inserted into the system in the insanity of ESG, which replaced balance sheets. So by virtue of that, her bio was her job.
Yes. And I think that we all need to take, I love where you're going with this, because I think we all need to take a step back and look at one of the, we all know this on the spiritual side, the insidious nature of all this stuff, but we need to look at the practical impacts, right? Because this is what living in this completely contrived, conjured environment does. Right? It takes people's eyes off of what really matters, whether we're talking spiritually, whether we're talking financially, whether we're talking culturally, and gets them out into la land where they're standing for nothing. So they're going to fall for everything. Right. And that's why I always say that when you see this craziness going on in the spiritual, cultural aspect, you can bet your bottom dollar the same insanity is occurring in financial markets. And I cannot explain to you, Todd, how ridiculous this whole thing is. Meaning, this wasn't a story of a bank that was being greedy. This isn't the story of a bank that over levered, reaching to make themselves more money. This was the most. I went off on Melvin Capital when Melvin Capital got killed being short GameStop as a complete ridiculous mismanagement of risk. This is a whole nother level. It really is stupefying, but it gives you a good insight. Like you said, right? They're at the front of the woke curve. This gives you a good insight of how much incompetence we have in very important places right now. And that is the systemic risk. There isn't this risk underlying the banking community that's about ready to blow up, because again, it's not a leverage issue. It's just gross incompetence. Problem is, you stack gross incompetence high enough, it can become a really big problem, right?
Right.
And that's where we're at in all this. And now, because of this, it's going to be really interesting to see what the Fed announces tomorrow morning, because again, let's separate ideology and what is really going on here. Do not think that I'm advocating a bailout. I am not. But if the Fed does not come out and backstop depositors, you are going to see runs at regional banks all across this country. Okay. And rightfully so. And this is one of the reasons. And then I've had some exchanges on Twitter where people are like, Zach, you said you don't need to be worried at banks. And I said, no, I said you didn't need to be worried at big banks. Okay. So if, and we can talk about that if you want to go down the way that people have. First of all, if the way that people should handle this, or what they should be afraid of, or what they shouldn't be. If you have balances below 250 grand at any banks, don't sweat it. You're covered by FDIC insurance. You'll be good. And I'm not just saying that from a rule. I'm in the thick of dealing with this right now with Silicon Valley Bank. And I'm just telling you, the FDIC insurance is good. If you have over that amount, you need to do something with it. If it's in the big banks, you'll be fine. If it's in the regional banks, you should be careful, because this saga is not over. And a lot of it's going to depend on what the Fed says and how they handle things on Monday morning.
Yeah. And so Yellen just announced that they're not going to bail the bank out, but they do intend to do something for the depositors. We'll see what that is, but that's in a way bailing the bank out. I mean, I get it, and it's going directly to depositors, and this also gets me a little bit concerned, because you had people in there, like you guys were talking about, you had your deposits spread out. So you had overhang in that bank of 150 grand, and that's on the company, right?
Yeah.
But you had people with 10 million bucks or something in there and that amount of cash should never be sitting in an account like that. These are some of the most sophisticated financial thinkers in the world, because I went through the chain of events. If you're a VC-backed startup, first of all, you got money from limited partners who are, you would presume, sophisticated financially. Well, I mean, there's actors and musicians, and maybe they're not sophisticated, but they give it then to sophisticated people. They're LPs, limited partners. That goes into a VC fund. And forgive me for thinking this, but I think they hire the best CFOs that exist, because they can pay, because these guys get to take a ride on the equity and the floats and the lift from the investment. So they get in, they get their 3% or whatever they get from partner flow. But they have VPs of finance. Then the startups have boards, and no one said, "Wait a minute, we've got $10 million in the bank that's not FDIC insured. It's naked."
But here's the problem. Okay, the best CFOs based on what criteria? For the last so for the last 15 years. Who are the best investors? Who are the best CFOs? It's the guys who have taken the most risk, right? That's who the best investors look like right now. Now we're watching them one at a time getting taken behind the woodshed and whooped, right? Because that's changing. But that's one of the insidious byproducts of what the Federal Reserve has done. They have created a no-risk environment. So all the good, responsible risk managers have had nothing but asset outflows for the last decade, because the returns aren't there, because they're not playing levered bets on Bitcoin. They're not going levered long Tesla, right? They're being responsible. They're managing risk. So the problem is you've got these people after 15 years of a zero risk environment. Who is sitting in the helms at these banks and financial institutions? It's not battle-scarred veterans who are sitting there going, this is ridiculous. It's the guys who have been pushing on the risk button the hardest for the last decade. So they're risk blind. They're risk blind. I cannot enforce. This isn't me being cocky. I just cannot enforce to you how stupid this was. These guys could have hedged out their duration risk a million times. Literally, I'm not bragging here. Had they asked me to be on the board 7 months ago and we'd have had this conversation, this wouldn't be happening today. I'd be like, hey guys, you got your tails hanging out over here on the duration side of it. You need to go buy some. You need to go buy some rate futures and things like that. Let's sterilize this rate risk. Rates are going higher. They wouldn't have this problem. And that's what should scare people. It's the gross incompetency, right? The other thing is they didn't know their deposit base was going to drop. All right. In the fall of 2021, we're on the radio sitting there going, get out of tech, guys. Rates are going up. This sector's about ready to get annihilated. Okay. So over 2022, when things were getting rocked and rates were going up, VC lending dried up. So all these VC startups started burning through their cash reserves. Deposit base started dropping. Okay. How these guys didn't see that happening in a rising rate environment, it's just stupefying. I cannot. And again, I think there's two things we can glean from that. A, this is not a systemic issue like mortgage bonds, which are about ready to blow up the financial system. But it is a systemic issue in the sense that the people we have in some of the most important places in this economy are morons.
And this goes back to the math, what you've said, when physics and politics collide, physics wins, math wins. So this goes back to the example I constantly use with you is the stock of Tesla is impossible given the cost of producing the actual guts of Tesla, because those items are completely mispriced. The lithium, et cetera, is so mispriced. So it's completely out of whack. But you're talking here about the stupidity of SBC where they could have hedged. Let me put a non-financial view in this together. This would be like you out in, let's say, in the ocean, and you're a little bit offshore and the water's cold and your boat is leaking. So let's say it's a big boat. You look down and go, hey, we got a leak. All right, we'll deal with it later. Yeah. All right, well, we could go to shore. Yeah, what's good? Okay, well, it's an inch. Yeah, but it's okay. And then you come back later and it's 4 inches. Okay, the leak now, 4 inches of water in the hull. No, we're fine. The boat is 60 feet tall. We're fine. Then you come back and it's 6 feet. Do you think we should go to shore? No, we're solid. We're good.
No, that's a perfect analogy. And what people don't understand too is how easy it is. Okay, so so they had $88 billion of long duration risk. Right, meaning that they had $88 billion worth of assets that as rates went up, those assets would get hit hard on the other side, right? So as rates went up, they'd keep bleeding, right? So $88 billion. I haven't done the math, but just from my experience with this, it probably would have taken them $1 to $1.5 billion of capital to hedge that risk completely out.
Oh, and you're shitting me.
No, and here's why. So there's something, and I'm not saying they'd use this, but people are like, what do you mean, Zach? And I'm like, well, because there's leverage in derivatives. So we were really concerned over the last week and a half, just about a bunch. It could take me 20 minutes to explain it, but just a lot of things we saw that we were like, okay, we feel like we're about ready to enter the other side of this storm. So we put something in our portfolios called volatility. Okay. On Friday alone, that position was up 30% on the day. Okay. So you can use stuff like that in the derivatives market where you can use a very little amount, but if something goes wrong, it makes massive amounts of money. So what I mean by that is that $1.5 billion position that they could have put on, it wouldn't have stopped the $88 billion position from getting hammered, but it would have been making as much as the $88 billion position was losing, right? And it was that simple. So no matter what happens, their capital base stays steady, right? And that's the kind of stuff that we do, right? We're doing it right now. Where you look at this and I'm going, these guys are running 200 billion. I'm running 700 million and we're hedging, right? You're looking at them going, what on earth are you thinking? It's just stupefying. And that's what I was saying is when you see that level of incompetence at a bank that size, they're not the only one. They're not the only one.
Okay, I want to talk about that. They're not the only one, but let me also point this out back to the scenario about the boats. So this would be like you're in your boat. You finally make the decision. Hey, maybe this is serious. Let's seal off the 6 foot that's flooded. Let's shut those doors, the compartment doors. So let's make sure it doesn't flood any further. We're still not in great shape. There's 6 feet of water in a 60-foot tall boat, but we're not going to sink. Now we can get this figured out. So it's not exactly right because you're talking about making money. and or at least, negating the loss by making money. But let me point this out, Zach. This is from it appears to be from a Silicon Valley Bank newsletter, on a mobile phone. Silicon Valley Bank commits $5 billion to sustainable finance and carbon neutral operations to support a healthier planet. So they could have committed 3.5 billion to that, took out 1.5, and you're saying sterilize this risk.
Yeah, exactly. The other issue they've got that nobody's talking about right now is and it's not nearly as big, but they have some of this stuff on their balance sheet. My suspicion is it's those positions that have kept them. I don't know this, but my suspicion is it's that stuff that has kept them from being bought at this point, because they're a very valuable franchise. Like you and I were talking about, they're an enviable. JP Morgan and Goldman Sachs would love to own them. Okay. There's a reason why they haven't bid on them. And I think it's that. My suspicion is it's that, because there is a ton of worthless paper and equity on a lot of these VC startups floating around right now. And I know Silicon Valley Bank has to have some of it on their balance sheet. And my suspicion is that may be what's the issue why you haven't seen a buyout yet.
Got it. Okay. So shifting gears, you'd mentioned, and I want to make sure that we're getting straight from you as you see this in terms of the larger picture. I'm looking at people saying that they're seeing Schwab, this is March 10 from this information. They saw Schwab fall, Bank of America, Wells Fargo, JP Morgan. And they're saying that this is the liquidity fairies leaving. And they're talking about, well, if Janet Yellen's not going to come in and bail this bank out, is that true? Has the liquidity fairy left town?
No, I think it's a little bit. Well, the liquidity fairy has clearly left town, which is one of the reasons every single week you and I have been talking. Think about it. 2 weeks ago, okay, NASDAQ was about 10% higher than current, and everybody was talking about a new bull market, right? And you and I were having this conversation, and we were both sitting there going, no, this is called a bear market rally. And the reason why is this is what we started saying a year and a half ago. When rates start going up, everybody's focused on rates. They're not focused on what it's going to cause. And there's something called a lag, or what my analyst, a guy by the name of Chase Taylor's phenomenal analyst for us, he refers to as the lag reaper, meaning this always happens. There's always a lag effect when you raise interest rates of usually somewhere between 8 to 12 months before you start seeing the impacts of those raises. And that's what we're seeing now. And this is why we've been pounding on the table, guys. And we've been saying this for years. And again, I'm not trying to sit there and go, we called it or anything like that. I'm just trying to illustrate to your clients or your listeners how relatively easy this stuff is to spot. When you've gone 15 years, when the cost of money is zero, and all of a sudden you jack that up to 500 basis points, okay, things are going to break. And what you're starting to see is this spreading. At first, it was the real estate market. Now you're starting to see it hit banks. And we've also been saying what you see happening in the real estate market is a preview to what this looks like in every other sector. Now, it's not going to be as serious in other sectors because banking and real estate are uniquely interest rate sensitive, but it's going to have this impact. And this is why we've also been saying that this whole discussion of recession, not recession, is ridiculous. Just wait until the lag reaper kicks in and you start seeing the impacts. And here we are. And it won't be the end of it. And I think that what this leads to is something that we've been talking about for years. And that is, at some point, the Federal Reserve has to pick, okay, their dual mandate, supposedly, right? And I laugh every time I hear somebody say that because I'm like, the Fed's mandate is whatever they want it to be on any given day. But supposedly the dual mandate is price stability, right? Keeping the value of the dollar stable and full employment.
Yep.
Okay. They're at a crossroads right now where they're battling inflation, and yet they're starting to see signs of a serious financial downturn, right? They got to pick jobs or inflation. So I put a little tweet out yesterday where I said, we may be at the point where dual mandate has become dueling mandates.
It's
right?
nice.
Right. I was proud of that.
Yeah, well said. So, let me ask you about some of the rumors. And this is also from Twitter. Bank of America, and JP Morgan Chase, and Wells Fargo, Citibank, Wells Fargo are drowning in net realized losses. Got to explain what that means to people, but is that your understanding, or have you not looked at that?
Well, I haven't looked at it, but we got to be careful about some of those reports. So first of all, any financial institution that's sitting on a pile of duration out there, meaning longer dated bonds, they're all in this position. So it really comes down to how they hedged it. I think most places like JP Morgan, this won't happen at JP Morgan, I can guarantee you. And just because it's such a rookie mistake, I can't emphasize that enough. But you could absolutely be seeing this happen at regional banks. But are they taking losses? Absolutely. And this is one of the things, over the last year, one of the a Jim Cramer favorite, or CNBC, a mantra they've been repeating over and over is, hey, rates are going up. Higher rates are great for banks. And we're like, well, higher rates are great for banks when they're lending. When lending is drying up at the same, if they're not writing loans at the higher rates, it doesn't help them. And as a matter of fact, you're forgetting about the other side of the balance sheet, right? What is their collateral? It's long dated treasuries, right? So on the asset side of the balance sheet, rates are going up. They're getting hit, guaranteed, right? The capital, their capital is getting hit on the longer side of it. But there's also something that they can do too. And this is why I want to emphasize it's not a systemic problem. Banks have a loophole on, I believe it's all federal securities. They can put in a bucket that's basically good to maturity, held to maturity, and their capital structure doesn't get hit. So that's why I don't think you're going to see these issues at big banks or anything like that. It's just not, but all the regional ones, they're at risk. But no, and that's why I think you're going to see more equity downside. And because none of this stuff, and that's what we've been saying, right? You get into an environment like this, nobody's benefiting, guys. Nobody's benefiting. And like you said, the liquidity trains leaving town. When the liquidity trains leave in town, go with it. Don't, get out of Dodge.
And none of us, neither you nor I, can confirm the rumors about Wells Fargo. People saying, wow, my direct deposit didn't show up. My paycheck didn't show up, and Wells Fargo saying, no, it's a computer thing. And we're dealing with it. And maybe it is, but we can't confirm that. But if that happens, if people's money starts disappearing from Wells Fargo, the country is in big trouble.
Yeah, but 100%. But I'm just going to say that's not going to happen. Okay. And again, this isn't me being Pollyannish, guys. You're going to hear a ton of fear porn. I don't want to use that word, but I don't really know what else to describe it as.
Porn, that's what it can be.
Yeah. And you're going to hear tons of it. Okay. The truth is that as weird as this sounds, this is where we've gotten. Okay. The banks that are the biggest, that have the most liabilities, are the ones that they're not going to allow to get hit.
So it's too big to fail, which is something we need to address societally, because that too big to fail thing, that's how you get your Johnny Risk, hey, I'm Johnny Risk, and I'm going to be a risk manager by pressing the risk button as hard and high as I can, right?
Yeah. And you know what I was thinking about though? I honestly do not believe that we need to even address the too big to fail, because I think that there should be room for that in a financial system. Meaning not to use the way that we use it now, which is just bail out everything. But there are things that happen that will create these black holes. And you need to have somebody that can step in and go, guys, look, we're going through a panic right now, but hold on. It's not a reflection of reality, right? I honestly believe, as I've sat here and thought about this for the last 3 days, I honestly believe that the single biggest thing you could do to stop this is make officers and board members of financial institutions personally liable for losses, period. If you did that, you would this never would have happened. This absolutely never would. And here's the thing, Todd, that's the way it used to be. That's the way it used to be. You go back and read Liar's Poker. Go back and look at Solomon Brothers. Back in those days, partners of firms were personally financially liable for the failure. Okay. If you just reinstituted that, it would fix the vast majority of these issues.
Yeah, but that's why people have lobbyists.
Right. Well, and this is This is something else you and I were talking about. It's that take more risk environment. When you think about how much these guys at these public institutions are making, they're getting paid like risk takers, and they have no risk on the table. None.
Yeah.
Right. So you want to make 20 million a year, your butt better be in the risk sling every day.
Yeah,
right?
That's really well said.
And otherwise, what are you getting paid that much money for?
Right. That's like, people want to be paid like the successful business owner. They want to be all paid like the Walton family. Well, Sam Walton took the risk. And
he risked everything.
Right. And many, many times mortgaging his house, and many, many times he risked everything. Right.
Yeah.
And as much as loathe as politics, so did Warren Buffett.
Yeah.
Warren Buffett's famous example of Buffett is he had a very successful newspaper route. The most successful, had the highest collection rate. So his customers paid. He's like 98%. And that was one of the big things about these newspaper carriers is they'd get all this bad debt. He got paid. And they came along and said, we want to give you more territory. So Warren Buffett, he said, no, I don't want this route. Here's what I want. I want a different route. Risked it all as a young man with nothing. What do you want? I want these 5 apartment buildings. What? You have all these beautiful homes, and you've got these people, these rich, beautiful, 8-bedroom homes, and you want these apartment buildings? Well, you're insane, but that's what I want.
More doors.
Right. That was it. And so his thing was, he got that, and he said, okay, so in the time it took me to do, my, 10% of my routes, I was done.
Yeah.
So, and I got my papers delivered. I got my billing delivered. Then he turned around, he got the rights to distribute Life magazine and Time magazine. And he fished where the fish are. People like to read. Yeah. So he was then adding to, hey, by the way, did you know I distribute Time magazine? Oh, I love Time magazine. Yeah, bring that to me. And Life and all those magazines at the time. And all of a sudden now he's done he's done horizontal marketing. He created a horizontal sales channel. A vertical sales channel. He verticalized vertical sales channel. Yeah. And this is a young kid.
Yeah.
And he and I believe it was the Washington Post who bought that route from him. They came and said, we gave you the route. Now we want to buy it from you.
Yep.
And okay, so there's a lot of hard work in that, but he risked it all. So he gets rewarded. But you make a great point that these guys sitting in the SVP chairs pulling in the 20 grand, 20 mil a year, we are their risk. Yeah, we are their backstop.
Well, and to go off the Warren Buffett analogy, Warren has taken shots for years. He's got about $150 billion worth of cash equivalents on his balance sheets. Guess how much in long duration, like Silicon Valley Bank, he's got? Zero. He's zero. He's taken shots for years because he's accepted lower interest rates to own short-dated U.S. treasuries. Why? For the same reason we were telling people for the last 7 years, get out of long-dated bonds. Because of this was coming. You just knew it was a matter of time. What did you think? Rates were going to stay at zero forever? Right? So Buffett's sitting there in short-dated treasuries right now with zero exposure. And again, why? Because he's been around and he understands these risks.
Yeah.
And, we don't have to like his politics to learn from the guy where you're just, it's a tragedy in terms of just a complete failure to manage risk. And I love the fact you brought up Buffett, because what is happening right now is what he's always talked about. The tide is going out. And when the tide goes out, you find out who's been swimming without their trunks on. And there are a lot of naked skinny dippers right now. And one by one, they're getting uncovered. Yeah. And there's going to be a lot more.
Yeah, that's well said. And I would just remind people of this as we go back and we talk about the personalities, that if there's a structural issue right now, it sounds like it's hiring people who virtue signal for a living, that their bio is their job. Their skin color is their job. Now, again, I don't know that this lady's not smart. I've never met her. I don't know her soul. Obviously, God does. But when your bio and your professional LinkedIn page is about your sexual habits, then I don't think that you have experienced the need for depth or acumen, because you've been able to just say, well, look, you need me in this position. You need the optics. I would remind people this: rely not on your own understanding, fear God, and honor his word. You do that, you go back through all of these issues. Why are we spending time talking about sexual habits with a job? That's not a godly thing. Why are we conjuring money? That's not a godly thing. right? Why are we not doing what we say we do? Well, why are we lying? That's not a godly thing. And like you say, when you see the spiritual sickness, you're going to see the financial sickness. And a lot of times the financial sickness will drive the spiritual sickness. And I've
Yeah.
spent enough time in Silicon Valley to tell you there's a little spiritual sickness there.
Oh, it comes in piles. I also think man, Solomon talks so much about this. The overlay of these issues, spiritual and financial, are so similar, right? Yeah. Well, we can hide sin for a while, but rest assured the bill comes due, right? We can stay at 0% interest rates for a while and convince ourselves we're all financial geniuses.
Yeah.
But at some point, that sterile environment, one of the things we always say is you cannot eliminate risk. Risk is ever present. You can delay it, you can morph it, you can move it, but you will always have to face it at some point. You cannot eliminate it. And that is what we are dealing with right now, where the medicine has become the poison, right? We are now paying the bill for 15 years and the Fed is stuck in a pickle, right? If they reverse policy and start cutting rates, inflation's going to take off like a rocket ship again, right? If they don't take action, they're looking at a bank run. This is why we've been saying for years, the Fed's going to box themselves into a corner where they got a gun on both sides of their head and they're asked, which side do you want it from? Right? And that's where they are. Here we are. And all you had to have to see it, honestly, was not a financial lens, a spiritual lens. Just sitting there going, you cannot get away with nonsense forever. The bill will always come due. Solomon can teach you that in about 5 minutes of reading over the course of 3 weeks. This isn't rocket science stuff. You don't need an MBA from Harvard to figure this out.
Yeah, really, really well said, Zach. And Zach is doing a free live webinar. It's coming up March 23rd, and he's going to explain how Bulwark Capital Management works, how active management of portfolios can actually lower volatility. You've heard him talk about risk management here. It's going to go back through the portfolio performance over 2022, other years. So you can talk about that. I think we just heard him explain why the 60-40 stock bond mix is a mess, but he'll go into detail on that. You can sign up at knowyourriskradio.com. Okay, it's a free live webinar, March 23rd, 3 p.m. Pacific time. But these things sell out. So go to knowyourriskradio.com. Investment advisory services offered through Tech Financial LLC and SEC registered investment advisor. Zach, I appreciate you jumping on at short notice to talk with people about this. And guys, this is up on Substack. It's up for subscribers. It will also be coming up later in the podcast. So we'll double down. We want everybody to know this. Thank you for coming on, my brothers, always. And I guess we'll also we'll do our show Friday and see where this all falls out.
Yeah, and just one other nugget for your listeners. If you're freaking out, it's one very simple thing you can do. Whatever your money's in, have it put into U.S. government treasuries or U.S. government sponsored money market securities, and you're going to be 100% fine. Those are 100% insured. You don't even have to move your money. Just make sure it's in one of those two things, and you're going to be fine. Okay, that's solid. Because I was just sitting, I went through this morning, look at our bank accounts going, are we exposed? Okay, so we're in money markets where we have cash, we're in money. You're good.
Markets.
Yep.
Okay.
You're fine.
All right. All right. Solid, Zach. Thank you so much. I always invite you and everyone else to go with God's good grace. Remind you, this is the Todd Herman Show. Please go be well, be strong, be kind, and hey, read Solomon, right?
There you
read
go,
Solomon.
man. There you
thanks
go.
to God for the wisdom. Appreciate you, brother.
Hey, thanks for having me on, man.